All right. The thing that I I kind of put myself in the shoes of a realtor when I'm looking at how can I market, how can I do better in this 2023 world, higher interest rates, fewer homes on the market. It seems like it's turning to become more of a buyer's market, more open houses are showing up, price reductions. And so we thought, as Tony Marino and myself, we thought, well, why don't we help you guys hold home buyer seminars? So this is going to be, you're going to see the presentation that Tony and I have put together that you can easily host, because we're going to give you Zoom, the Zoom software. All you have to do is look around for family, friends, prospects, past clients. Past clients have sons and daughters. Past clients have brothers and sisters. Invite them to learn how to buy a home in this environment. You're going to see some really cool things that you can bring to their attention as to why they should attend. And we're going to have you host it. You're going to do the introduction like I'm doing. You're going to say hello to them. You're going to then introduce your guest speaker, Glen Marino. And from there, you're going to close out at the end by saying, thank you for attending. This is the action, the call to action. For those that want to take that next step to become a homeowner, here is my contact information, meaning you, the realtor, your contact information. Please contact me at this cell phone number, at this email, and we'll get started with my team. So without further ado, this is going to be what the presentation would look like. You're going to sit through it for about 45 minutes and learn what your customers, your invitees, would be seeing. So here we are at the home buying seminar. This was one that we did with our wonderful, friendly Pam Greer and with Tony Marino. So it's your journey toward home ownership just got easier. It's the home buying seminar. And the guest speakers are Tony and Glenn. Let me bring this up from the beginning in big screen. Can everybody still see my screen? Did they go to the next slide?
Yeah. Yes.
Okay. So here's a little something about Tony Marino. He's the branch manager for the Marino team in Naperville. He's a loan originator. He's licensed in Illinois, Colorado, and Florida. By the way, you might have some Illinois people that are actually moving out of Illinois as they get a little bit older, want to retire, and they're moving to Colorado, they're moving to Florida, and you and Tony can follow them there and help them get financing on their retirement home. He specializes in getting people into home ownership using down payment assistance. He uses education to help people understand how they can become homeowners and own a part of the American dream. Tony, why don't you unmute yourself and just say hello to everybody?
Hey everyone, how are you?
All right.
I'm going to let you guys see him and hear him, and he's been doing a terrific job of getting people to closing on a timely basis, plus educating them. So many people don't think they're eligible for home ownership, and that's something that Tony spends a great amount of time doing, is holding their hand, helping them understand what their credit scores are and how much of a home their income can support. So we really appreciate everything that you do, Tony.
Thanks.
So the American dream. Home ownership is still the American dream, and buying a home can be exciting, yet an intimidating process for many. We believe in the American dream, and I feel most people still do, but are unsure as to whether it's achievable anymore with these rising interest rates. This Homebuyer workshop will present you with the information that will help to prepare you to purchase a home. Again, put yourself in the shoes of one of your invitees. Why have this workshop for you, Mr. or Mrs. Potential Homebuyer? Well, there's a need or a want to become a homeowner. Isn't it the American dream? However, there's way too much misinformation out there, such as how much of a down payment do I need? If you ask enough people, majority of the people think they have to put 20% down still, and that's just not true. I mean, you can put down as little as 3.5% on an FHA or 5% on a conventional. It's becoming more of a buyer's market. And with that, they need to know some of the tools that they can do to successfully make an offer on a house. As we mentioned, becoming more of a buyer's market because we're seeing price reductions. It's more of a buyer's market because we're seeing houses stay on the market longer. So again, we need to be in a position as realtors to be able to educate our people, help them understand that home ownership is pretty doggone easy. We need to improve their knowledge of the home buying process and home ownership concerns. We want to set aside the individual's lack of confidence. They think that they're years away from owning a home, or in today's environment, because of high interest rates, they think it's years before they're going to go into the market. And we're going to see later on why they should go into the market now versus waiting later. 50% of the renters think they can't afford the down payment, yet they have the financial means to maintain mortgage payments. Many of the rental monthly payments are equal or greater than what a mortgage payment would be. So they can make the monthly payment. They just don't know how to get to that process of becoming a homeowner. There's also, we're going to educate individuals on the financial assistance available to them, such as the IDA down payment assistance programs. Home ownership obviously enhances the quality of life. It's something you own, it's an appreciating asset. And we're going to help individuals with wealth building and equity appreciation. We have seen that people that own homes have a net worth 45 times greater than someone who remains a renter. So who is this workshop good for? Well, if you're a renter, it could be an existing homeowner. Your family was just you and your wife. Now it's you, your wife, you got 2 or 3 children, and the house isn't big enough. You need to upsize. Could be your sons and daughters. I've had 2 daughters that have bought with down payment assistance. So all you have to do is look in your own backyard. Some of your children could be people that could use this. Family members that dream of home ownership, friends, anyone who thinks they can't buy a home because they did not save enough money. Anyone who thinks they can't afford the housing payment because interest rates have increased. And again, we're to dispel that rumor because they can't afford it, and there are other methodologies or strategies that's going to make them feel comfortable with where interest rates are today. With myths, we've got 45% of the people think they need a very good credit score to get a mortgage loan today. In fact, some of them think that a good credit score is 780. Well, we can do an FHA loan all the way down to 580. You can get down payment assistance with a score as low as 640. 35% of them think they need 20% down payment, which again is an old wives' tale. And 31% don't think they could even qualify for a mortgage loan. Those are the self-defeaters. Those are the ones that haven't even tried. They haven't even talked to a realtor. They haven't even talked to a loan officer to see for free, doesn't cost them anything, to find out what their credit score is by having a free credit report run. And 2, going through the pre-approval process. How much does my income support? And yet these are the people that don't even take the first step. And so they think they can't even qualify. So how do they overcome these issues? Well, the realtor and the loan officer will be their advisors. You guys are the experts at what you do. Your realtor will work with you to find you the perfect home, and the loan officer will work to find you the best down payment assistance programs, be it $10,000, $7,500, or $6,000. And we'll look into greater detail on those in a second. Both the realtor and the loan officer will hold your hand and guide you through every step of the way. By the way, did I say that your realtor and Tony are very friendly? The advantages of home ownership. It's a place of your own. You end up with stable housing costs. In the rental market these days, I keep seeing rents go up, up, and up. Wouldn't it be nice if you could just stabilize your housing costs? You build equity. Housing typically is an appreciating asset. So what you buy it for today, and when you sell it 10, 15, 20 years from now, it's typically a much larger selling price. Thus, you've built up a bunch of equity. You're building your worth. You get tax deductions on interest and real estate taxes. You can borrow against the equity that you build up in your home. Say you build up $50,000 in equity in the next 5 to 10 years. But now all of a sudden, you'd like to build a new garage, or maybe you'd like to build an addition, or maybe you'd like to finish that basement. You can use the equity to go get a home equity line of credit. Or you can convert it to cash later when you retire. I've got several people now that as they've retired, they'd like to take the equity. They're either mortgage free or they're almost mortgage free. And what they're doing is using the equity through a reverse mortgage to get them about $2,000 a month in addition to their Social Security. So they're letting the equity in the home pay them for the rest of their life. And as I mentioned before, homeowners have 45% greater net worth than do renters. Some other advantages: stop paying rent to a landlord, move out of your parents' home, or more importantly, the parents want you to move out of their home. Gain independence, pay less in income taxes, and increase one's wealth by acquiring, purchasing, and appreciating asset. Now, buying a home is a huge step. It's going to be the biggest asset that most people are going to have in their financial statement. But buying a home doesn't have to be that confusing nor that challenging if you go with one of these wonderful realtors or you go with the wonderful loan officer. We're going to hold your hand. We're going to dispel the myths and educate you on the steps toward home ownership. That means include reviewing your credit report. Maybe you don't have a 580. Maybe you don't have a 640. Well, we're going to help you fix that credit. We're going to give you loan options. Is it better to have an FHA loan, or is it better to have a conventional loan, or is it better to have a VA loan? What down payment assistance program is best for you? Is it better to have 10,000, 7,500, or 6,000? We're going to work with you, getting you pre-approved. Then what happens in the processing, underwriting, and closing of your loan. This improves an individual's confidence in their ability to purchase a home. If they know that they've got the right credit score, if they know they can get the funds needed for down payment through down payment assistance, if they know how much of a loan their income can support, they're going to want to work on any issues. If they have to pay down a credit card, or if they pay off their collection, they're going to want to work on issues because they know there's light at the end of the tunnel. They can become a homeowner. They're going to address credit issues and qualify for a mortgage. We're going to give them advice. We're going to give them advice and recommendations specific to their individual situation to meet credit score debt ratio requirements. We provide financial assistance to overcome a lack of funds. It's probably the number 2 reason people don't buy a house. Number 1 is credit. They don't have the 580, they don't have the 640. But the second biggest reason is they go, you know, I'm one of those people. I live paycheck to paycheck, or I have over less than $1,000 in savings, or I have just enough in savings that if my landlord decides not to renew my lease, I've got my first month's rent and security deposit. I got $3,000 or $4,000 in the bank, and that's it. So what we're going to do is we're going to help an individual overcome a financial barrier to home ownership. Financial assistance typically is used for down payment. Usually, if it's an FHA, it's 3.5% down. On a $200,000 purchase, that's about $7,000. We're going to help them with closing costs. Those are typically about $5,000 on most purchases. So your team, the realtor and the loan officer, they can provide access to the IDA, the Illinois Housing Development Authority programs, for $6,000, $7,500, or $10,000. And they'll also find what's best for you. Is it better that you go with an FHA loan or a conventional loan? The homeownership process starts with the lender. So here's where we're going to make them comfortable with the process. What are the steps that we take? Well, the first thing you do is you're going to get pre-approved for a home loan for free. Take advantage of all the free opportunities. Free pre-approval. We have something called FCM Express, and we'll see later on. We're going to download it, and we're going to show you how easy it is for them to calculate their mortgage payment and get started immediately on getting pre-approved. The lender determines how much they can afford by having them fill out an abbreviated loan application. The lender can help improve their credit score if necessary, if they don't have the 580 or the 640. The lender can make suggestions or give them a credit repair plan. And the lender can provide them with any needed financial assistance, as we mentioned, through the IDA down payment assistance program. After they're pre-approved, they got a letter now in their hand. Typically, we send it also to the realtor. Now they're going to meet with the realtor further to discuss their housing needs. What price range should they be looking for? The realtor is going to look at your pre-approval and say, oh, you've been pre-approved for $300,000. We can look at, homes that are on the market for $325,000 to $275,000. What size home do you need? Is it a 2-bedroom, 3-bedroom, 4-bedroom? What size bedroom? How many bathrooms do you need? Do you need a backyard? What kind of neighborhood do you want to live in? Do you want something that's urban, such that it's near nightlife and near museums and near theater? Or is it something you want to be out in the suburbs, where you're near soccer fields and baseball fields? Or do you just want to be out in the country where your neighbor is not, next door to you, but he's, a half a mile down the road? And what kind of lifestyle? The realtor's going to know what kind of lifestyle are you looking for? Are you looking for, are you over 55 and over? Are you looking for a quieter community? Maybe a 55 and over community? Or is it something that you like, your lifestyle is, you like to be active, you like to be involved in sports, you like to be involved in soccer, in baseball? They're going to be looking for those types of events that are going to be in the neighborhood or where you're going to be purchasing a home. So once they narrow it down and you have found the house that you've fallen in love with, the realtor's going to help you make an offer. They're going to do it. They're going to put together a purchase contract, put down how much earnest money you're willing to give. And, and also in the contract, they'll put down what is the loan amount you're looking for, because the remainder is your down payment. Once your contract has been accepted, meaning the realtor is going to go back and forth and negotiate with the seller, and you guys are going to come to a table of expectation. You're going to come to an agreement on what the purchase price is going to be. And once you've agreed to that and it's signed and accepted by the seller, you're going to select an attorney. The realtor and or the lender, they can refer you to an attorney of choice unless you have one already. You're going to perform your due diligence. You're going to do a home inspection. Again, remember we said this is your biggest asset on your financial statement. You're not going to want to buy a house without knowing how good are the bones, how good is the foundation. Do I have mold in the basement? Do I have mold in the attic? How old is my hot water tank? These are all sorts of things that you're going to want to find out in your home inspection. You might end up having a radon inspection to make sure that the house is also safe for livability. Then you're going to send the executed contract and the loan documents to your lender, to Tony Marino. Tony's going to then go through the processing department with your loan. He's going to order the appraisal, find out what it's worth. Did you overpay or underpay for it? They're going to order verifications of employment. They want to verify your income. The loan goes to underwriting, where it'll be approved, declined, or suspended, and it's going to come out with what I call conditional approval. Conditional approval is going to be asking for an updated pay stub, an updated bank statement. Explain this on your credit report. And once you do those few items after conditional, you're going to get a clear to close. They're going to set you up to go to the closing at a title company where you're going to bring the funds that are necessary for closing. At the closing, you're going to close at a title company, say Chicago Title, or you're going to go to an attorney's office, might be the seller's attorney's office. You're going to sign documents that make the house yours, and the seller's going to receive a check. You're buying it. They get a check. Largely the money you're borrowing from the lender. You, the buyer, you receive keys and the deed and the garage door openers, and you move in. So why don't most people buy a home? Well, they say, I don't have enough money. I got enough money for a security deposit and first month's rent, but that's all I've got. I don't have 3.5% down. I don't have $5,000 in closing costs. Or they say my credit's not good enough. I don't have the 580. I don't have the 610. Or they just don't think. They're self-defeaters, as we mentioned before. They don't think they can buy. So given the chance, would you like to stop renting? Would you like to move but don't have a lot of equity in your current home to give you enough for a down payment? Would you like to keep your assets invested and not liquidate them for a down payment or closing costs? Would you like to buy a home for as little as 1% down? Well, there's some exciting loan programs that meet those. We're not going to go through all of these. I'm just going to mention a couple of them, such as there's a 100% VA loan. You can borrow 100% of the purchase price if you're a veteran. You can borrow 100% if you're doing a USDA loan. You get 97% if you have very good credit, meaning put 3% down and do a conforming loan. Today, we're going to focus on the 3 in red. We're going to focus on the $6,000 IDA Open Doors Forgivable Grant Program. It is an FHA loan. So you're going to have to put 3.5% down, but you're going to get $6,000 that's forgivable over 5 years. We're also going to concentrate on the $7,500 IDA Access. It's a loan. It's a zero interest loan. I call it the Crazy Good program. You get to borrow. You get to borrow $7,500. There's no interest on it. So in 20 years from now, you still owe $7,500. There is no payments on this thing for 20 years until you actually sell the home. So the payment, the repayment of the 7,500, it's the first to happen either 30 years, at the 30 years, yeah, you owe it back after 30 years, or whenever you sell the house. Where was that deal when I was trying to buy a house? That's a great deal. Give me $7,500. I don't have to pay anything for the next 20 years while I live in it. When I sell it, I'll give you back just $7,500. Pretty good deal. Last but not least, it's the one that I like probably the most. It's $10,000 IDA access. It's another zero interest loan. Here's $10,000. You get it. No interest on it, except this one requires a monthly payment of principal only. And it's a repayment over 10 years. 10 years times 12 is 120 payments. 120 divided into $10,000 is $83.33. Okay, so here's my proposition to you, Mr. and Mrs. Almost Homeowner. If I give you $10,000, could you forego one dinner a month? Because I've asked people, how much does a dinner cost? You and your significant other, you offer a nice dinner, a glass of wine. Well, then depending on the restaurant, $60, $80, $100. Okay, so if you give up one of those a month, you'll have $83.33. So if you can pay $83.33, I can give you $10,000 towards your down payment and your closing costs. Is that a deal? That's a deal. Let's move on. Let's start looking at houses. Again, these are the same programs that we just talked about. The $6,000 is a forgivable grant over 5 years. So if you stay in the house for 5 years, you owe nothing back. The $7,500, again, it's a loan, zero interest. You owe nothing back until you sell the house or 30 years, whichever comes first. And the $10,000, that happens to be the one that's repayable. It's a zero interest loan, $83.33 a month. So what are some of the eligibility? How do we get to that money? I got a down first month security deposit and first month's rent. And I don't want to stop renting. I want to stop renting. I want to get some of this down payment assistance. How do I become eligible? Well, first off, it's available for first time and non-first time home buyers. Key here is non-first time home buyers. You realtors who have past clients, maybe the houses that they're in right now, it's gotten too small. They've got more children. They want to upgrade, they want to downsize, and yet they may not have the necessary money for down payment and closing costs. Well, it's eligible to them. Current homeowners can take advantage of this. They must purchase a 1 or 2 unit property. I love this for 2 unit properties. I mean, obviously it's great for single families, for condos, for townhouses. But if they buy a 2 unit, whatever monthly payment there is for principal, interest, taxes, and insurance, the housing payment, even if they're renting it for $1,000, their payment's $1,000 less. It's really cool. You'll see that later on. The borrower must occupy it as their primary residence. No, they cannot use this program for investment properties, and no non-occupant co-borrowers are allowed. What does that mean? It means Glenn, myself, if I wanted to be a co-borrower on my daughter's loan, I'm not going to occupy her house, but I also, under this program with IDA, where you get 10,000, 7,500, 6,000, they're not accepting non-occupants, meaning the parent, who's also going to be a borrower. So that's not allowed under this program. And they're all going to be 30-year fixed rate programs, meaning the down payment assistance of 10,000, 7,500, or 6,000, it's really a second mortgage. The first mortgage is going to be whatever Tony and the loan officer say is in the very best interest. Is it a VA loan? Is it an FHA loan? Is it a USDA? Is it a conventional? Their first mortgage will be determined on what's best for them. And then depending upon whether they take 10,000, 7,500, or 6,000, it's a second mortgage. There's income and property limits, which we're going to take a look at shortly to get to the IDA funds. To get to the IDA funds, I must have at least a 640 credit score. Okay, a lot of people have that. But what happens if they don't? That's what Tony's for. He'll do a what if scenario. He'll find out what action steps you, the borrower, need to take in order to get your score above 640. Your debt to income ratio cannot exceed 45% in order to be eligible for the IDA fund. The borrower must contribute 1% of the purchase price. So on a $300,000 purchase, they must come up with $3,000. But you gotta remember, they already have in the bank their first month's rent and security deposit. So if they're you know, if they're spending $2,500 on rent and their security deposit is 25, they got $5,000 sitting in the bank. So this looks great if all they got to come up with is 1% of their own funds, and the rest of it we're going to see we can get from either the seller or we can get it from IDA. Homeownership counseling is required. They can do that online, which is really great. It does prepare them for home ownership. They're coming from being a non-homeowner, a renter, or living in mom and dad's basement to now they're going to become a homeowner. The homeownership counseling is very good, and it's required that you take it and turn in a certificate. IDA's interest rates, the beauty is they don't have to shop around for it. There is only one interest rate throughout all of Illinois. One interest rate, and it comes out every day, and it's good from 9 o'clock in the morning till 5 o'clock at night. So one interest rate. They can't go, oh, I wonder what that lender down the street has got for an IDA loan. The IDA determines what the interest rate is going to be for your VA, for your FHA, for your conventional loans. And it's the same interest rate for everyone. The interest rate is the rate for the borrower's first mortgage, FHA, conventional, VA, or USDA. And the IDA down payment assistance is a second lien or a second mortgage on the property with only the $10,000 zero interest loan requiring repayment of $83.33 a month. Here's today's interest rates. They're better than if they went out into the FHA market or the conventional market. So for example, here is the forgivable 6,000, it's 5.625. Here is the 7,500, it's 5.625. Here's the $10,000 repayable, 5.625. This is the $6,000 program that's forgivable over 5 years, 5.375. These rates are lower than if they went and did it without down payment assistance. So these are great rates with great benefits by giving people down payment assistance. Here is the income limitation in Cook County, Kane, Lake, McHenry, McLean, Will, DuPage, 125,040. I don't know about you guys, but I know a lot of people. I mean, a lot of people who make less than 125,000. And that means they qualify for down payment assistance. You get a green light for that. The second thing is they can purchase up to a single family in Cook, Kane, Lake, McHenry, DuPage, a house up to 350,000, 349, 525. That seems to be, I'll bet if you looked at your past clients, majority of them have purchased something under 350,000. So now if you have a client that's purchasing something for under 350 and they make less than 125,000, your green light should go off and say, you know, you might just qualify for down payment assistance. Let's see if you have a 640 or better credit score. Let's do an example. Let's check out rent versus buy on a $300,000 loan, 3 buckets of cash. So assuming that you got a $300,000 home, assume that, you know, of the down payments, we choose FHA, which is 3.5. We're going to go for the biggest down payment assistance, $10,000. The average closing costs are $5,000. And if you take the IDA down payment assistance, the lender charges IDA charges a 1% fee. Cool. So if we rent, and again, the realtors, you would know better than I would, but the rents on a $300,000 home could be as much as $3,000. Even if it was $2,500, that means that their first month's rent is $3,000, the security deposit's $3,000, that's $6,000 out of pocket. If it was $2,500 and $2,500, that'd be $5,000 out of pocket if they stay renters. Own nothing, no appreciating asset, great. If they purchase, there's 3 buckets, bucket 1, bucket 2, and bucket 3. Bucket 1 is down payment. You always have to ask who pays it. Well, 3.5% on 300,000 is 10,500. Who pays that? Remember, I just said 1% of the purchase price must be their own funds. So in yellow, those are the numbers that we're going to take, that the customer has to come up with. So the customer's got to come up with $3,000. Cool. Well, how do we get to the rest, 10,500? Who pays? Well, IDA can pay. We got a bucket of $10,000. So we'll use 7,500 of it. And now we've got 7,500 and 3,000. We got 10,500, put a check mark. and say, I got all the money I need for bucket number 1 down payment. Cool. Customer's out $3,000 versus $6,000 over here. Second bucket, closing costs, $8,000. That's the $5,000 normal closing cost plus the origination fee of $3,000. $8,000. Customer says, Tony, Christine, I don't have $8,000. What are you wasting my time for? This is crazy talk. You know, I only got the first month's rent and security deposit. Let's just go back to renting. And then Tony and Christine go, but how about if we use the remaining $2,500 from Ida? Because we only use $7,500 of the $10,000, so we got $2,500 left. And what if we were to then have the seller pay $5,500 of the remaining closing costs? Obviously, the realtor would negotiate with the client, and we're going to see a little bit how that can happen. After they ink the contract and put it together and make an offer, the realtor can go back to the seller's realtor and say, my client no longer wants to pay $300,000. With a big sign the other end of the phone, what do you mean they don't want to pay $300,000? Nope, they want to pay more. All of a sudden, the person on the other end says, this is pretty interesting. They don't want to pay $300,000. They want to pay $305,500, $5,500 more, provided that your client will pay $5,500 in closing costs. So they take out their calculator and go $305,500 minus the credit for $5,500 equals $300,000. Well, that was the original amount that the seller had agreed upon. So why should the seller not agree to increasing the price and giving back a credit for $5,500? There should be no argument at all. So assuming that can happen, there's $5,500 plus the $2,500 from Ida. We've got $8,000, put a check mark, and bucket number 2 is satisfied. Bucket number 3 is prepaids and escrows. What are escrows? Escrows are what you're going to have to set aside with the lender to pay your real estate taxes twice a year. It's also what has to be set aside on a monthly basis to pay your homeowner's insurance in the event of fire damage, hail damage, etc. And that's going to get paid once a year. The good news here is that in the state of Illinois, we pay our real estate taxes in arrears. So what does that mean? We're in the year 2023. In the year 2023, we're paying 2022's real estate taxes. So let's just say, for example, we had a closing in July of 2023, July 31st to be exact. So that means for 7 months, the seller has lived in this house. Well, the seller has to give our buyer 7 months of real estate taxes as a credit. And what you can go to the bank on is the credit from the seller always, always, always exceeds what the lender wants you to set up for real estate taxes and homeowners insurance and an escrow. So this bucket is always 0 or negative. I don't go negative, but it's always 0. Most of the time it's a negative number. Bucket number 2 is 0 because Ida and the seller paid for the closing costs. And bucket number 1 is $3,000. So the guy who had enough money for his security deposit and first month's rent is now clicking his heels because the realtor and Tony as a team just educated him how he could buy a $300,000 home for $3,000. They're going, this is fantastic. Here's a little short quiz for you. What if the earnest money in the contract was equal to 1% of the purchase price? So say, go back to our example, $300,000 home, you say, I'm going to give you $3,000 in earnest money. How much cash would the buyer have to bring to the closing? 0, because he already gave the 1% up front when he made the offer. How'd you like to be going to a closing and Tony and the processors tell your client, oh yeah, you're going to closing this Friday, and make sure that you bring a check for, oh, by the way, you don't need to bring a check, it's 0. Kind of a fun feeling. So what is your housing payment on a $300,000 home? Well, your loan is $294,000, so the principal and interest is $1,695. Remember, down payment assistance, the $10,000 requires $83.33. You got to pay that monthly. Your taxes are $553. Your homeowner's insurance is $100 a month. And that Arch MI from Faith Henderson is $205 a month. I venture to say, based upon her examples that she just gave today, this 205 is too high. But let's just say it's good. It's going to be conservatively high, and we can make it even better. So when you add this up, your monthly payment is $2,636. This assumes an interest rate of 5.625. Remember, we looked at the interest rates for Ida. They were 5.625. So that is your payment, $2,636 versus renting of $3,000. Or even if your rent was $2,500. Wouldn't it be better to be a owner than a renter? Me thinks that would be quite exciting. And what if this was a 2-flat? What if you're buying a 2-flat for $300,000? In the second unit, you lived in one of the units, and the second unit you rented out, and say you'd rented it out for $1,000 a month. Aren't you going to subtract the $1,000 from the $2,636? So now your payment is $1,636 for living in a $300,000 2-unit. Not bad. Let's take a look at a $200,000 one real quickly. What if we purchased for $200,000 purchase price, used FHA again of 3.5%, used the $10,000 down payment assistance, same closing cost, $5,000, but the origination fee is $1,930. So again, the rent might be $2,000 and their security deposit $2,000. So they got $4,000 in the bank. And they go, doggone it, I can't be a home buyer. I don't have the down payment. I don't have the closing costs. So just show me you're a leasing agent, realtor. Show me another rental place. I can't be a homeowner. So then all of a sudden you bring out this worksheet with Tony and you go, well, let's go through the 3 buckets. Bucket 1, 3.5% of $200,000 is $7,000. They had to come in with 1% of their own funds, $2,000, and there was still $5,000 left over. Take $5,000 out of the $10,000, that's $7,000, put a check mark. You got all the money you need for bucket number 1. Bucket 2, closing costs are $6,930. Okay, we don't want the borrower to pay anything, so Ida's got to come up with the remaining $5,000 because $5,000 was still left in the $10,000 bucket, and you only have $1,930. So again, your realtor says, tell you what, client doesn't want to pay $200,000 anymore. Even after we put the offer together and we want to pay more for your house. We want to pay $202,000, provided that you give us a $2,000 credit toward closing costs. And the seller takes out their calculator and says 202 minus 2,000, it's $200,000. They think this is fantastic. And so does your buyer client. He thinks this is great. I came up with 0 for my closing costs. And last but not least, bucket number 3, the prepaid escrows. Remember the real estate tax credit because the seller owes the buyer for the number of months that they lived in the house, July 31st, 7 months they've lived in the house in 2023, they must give the buyer a credit of 7 months. And that credit is always bigger than what the lender is going to ask them to set up for real estate tax escrows and for homeowners insurance. So they just bought a home for $2,000 or $200,000 for $2,000. And they go, you're fantastic, realtor. We love you. We think we want to tell our family, our friends, our business associates, how you're helping us become a homeowner. They're going to say the same thing about Tony Marino. They're going to say, we love him. This guy's, they're magical. This team is fantastic. So again, what is your payment if you buy a $200,000 home? Using 5.625, which is today's rates on Ida, your payment would be the principal and interest, the down payment assistance of $83, the taxes, homeowners insurance, and of course, Arch's MI, which is too high. I'm sure I'm hearing Faith in the background going, that's too high, Glenn. But it's at least $1,842 versus $2,000 in rent. They're going to go, this is great. I no longer am a renter. I had the money sitting in my savings account. I had first month's rent and security deposit. You guys used it to help me buy a home, and my payment is less than or equal to what I'm paying in rent, and I get tax deductions, and I get my own backyard, and I get an appreciating asset. Who else can I talk to, tell about this? I got 20 friends I want to tell about. So let's summarize the 3 buckets of cash. Bucket number 1 was down payment. All 3 buckets, you always ask who pays. When bucket number 1, you can pay, if you're crazy enough, you can pay or Ida can pay. It's 3% on a conventional loan with high credit. It's 5% with lower credit scores. but it's 3.5% if you do a conventional FHA without down payment assistance, and we go all the way down to a 580 score. Or you can put down 1% of your own funds on an FHA loan. That's your share if you use the IDA down payment assistance program of $10,000, $7,500, or $6,000. Now, again, if somebody has some money, more money to put into the transaction, Tony will move them into the $7,500 program because they don't need to pay the $83 a month, or he'll move them into the $6,000 program. We start with the 10, and then we work our way down if they don't need as much because they've got extra funds sitting in savings already. So that was bucket number 1, 1% of the purchase price. Bucket number 2, closing costs. Always ask who pays. Remember we said there are approximately $5,000 in closing costs, and it's an additional 1% fee if you use the IDA funds. So who pays that? Well, you can pay. I don't recommend it. IDA can pay. We highly recommend it. Your realtor can negotiate to have the seller pay. We highly recommend it. The seller can outright agree. You know, they're a motivated seller. They're moving out of state. The house has been on the market for 61 days. They want to get it sold. They might just outright agree. If not, your realtor will ask if we, meaning you, the buyer, you can pay $5,000 more for their house. They'll scratch their head and say, this is the most unusual buyer I've ever seen. They don't want to offer me less, they want to offer me more, provided that the seller pays $5,000 of the closing costs. And as we've seen with the calculator, the seller goes, well, I'm back to where I started. Why shouldn't I do this? Your lender can also pay for closing costs on non-IDA loans, where we can, if the interest rate is say 6%, we can start increasing the rate to 6.25%, to 6.5%, to 6.75%, and we can then give you back a credit toward your closing costs. How do you get, I think we've covered this already, seller closing cost assistance. How do we get the seller to give us a credit for closing costs? Well, in order to get closing cost assistance, you must first set the table of expectation. You have to have already negotiated the price. You have to agree on $200,000. You have to have agreed upon $300,000. You can't be in the process of trying to figure out what will the seller settle for. And that is the price that's agreed between a willing buyer and a willing seller. So you got it down pat. It's $300,000. Then what type of property, is best to try this on? Well, ask a realtor to find you homes with motivated sellers. Home that's had at least one price reduction or has had many days on the market. A motivated seller will typically sell for less. A motivated seller allows you to gross up the purchase price and will participate in your closing cost assistance. So you offer the seller a higher purchase price by the amount of the closing cost. If the table expectation was $200, you offer $205, provided the seller pays $5,000 of the closing cost. The one caveat that we have to say here is the realtor must check to see that the home will appraise for the increased purchase price. Say, we're going from 200 to 205, at least the realtor needs to check other comparables in the area. Is their value at least 205,000? Otherwise, you're going to be going into that appraisal gap strategy that Faith Henderson was talking about earlier. What are people's reaction to this grossing up of the purchase price to get the seller to pay closing costs? Well, the seller is very happy. He's still receiving his table of expectation, is $200,000. What's the realtor's reaction? Well, they're very, very happy because they get paid more commission on a higher purchase price. It's not 200, it's 205. And what's the reaction of the buyer? Where they're very happy. How much of their own money did they use for closing costs? Nothing. Bucket number 3, prepaids and escrows. Always ask who pays. Well, prepaid interest is the interest you pay from the date of your closing to the end of the month. That is why purchases typically take place closer to the end of the month. So if you close on January 31st, you're only using the lender's money for 1 day. At the closing, you're only going to have to pay for 1 day's worth of interest. Good. Your escrows, as we mentioned, are for homeowners insurance and for real estate taxes. So typically there's going to be 2 months of homeowners, 2 to 8 months of real estate taxes, depending upon the month of your closing. And the big thing to always take away from this seminar is the seller credit for real estate taxes is always greater than what the lender will ask you to set up for your taxes and your homeowner's insurance. So the seller's going to give you a credit for the number of months that they've lived in the house. This bucket is always zero except on new construction. So how much of your own funds is used in the purchase of a home, new homeowner to be? Bucket one, 1% of the purchase price. Bucket two, closing costs, zero, because Ida and the seller paid it. Bucket three, zero, because you got a seller credit for real estate taxes. So what are you waiting for? Should we take some action? Should we start working on showing you houses? And what's your reaction? You're saying, no, I'm waiting because interest rates are too high. You believe rates will be lower in the future? Well, would you take action if your interest rate could be 2% lower in the first year and 1% lower in the second year? Well, what do you mean, Glenn? I mean, for example, if interest rates are normally around 6% now, would you take action if your interest rate was 4% in the first year and 5% in the second year? So let's explore what a temporary buy down or a 2-1 buy down means. Temporary buy down is where buyers can buy down their mortgage payment for up to 3 years at the beginning of the loan. It can be used for their primary purchase of single family, a townhouse, or a condo. They can use it on conventional, FHA, or VA. The key here is that the seller must pay the buy down fee. So here's a strategy. Instead of the buyer strategy, and then let's drop down here. Let's first take a look at what does it mean? What's the buy down fee? How do you calculate it? So if you look down here, the loan amount is $375,000. The interest rate normally, without any buy down, is 6% in today's marketplace. Okay, so in year one, we would prefer 4%. Well, at 4%, they would move forward. But at 6%, they're having, they're having heart palpitations. It's too high. So what you say is, okay, well, your normal payment is $2,248 at 6%, but at 4%, it's $1,790. So monthly, we're going to save you about $458 times 12. We're going to save you $5,500. And the buyer goes, that's great. I love it so far. And in the second year, the rate will be not 6%, but 5%. Normally, your payment's $2,248. At 5%, it's $2,013. You're saving $235 a month times 12, or $2,800 a year. Add 55 and 2,800, you get $8,300. That's the buy down fee. Must be paid by seller. So what do you do as a strategy? Instead of offering a lower purchase price, doesn't every seller anticipate when it's a buyer's market that the list price is not what they're going to get? They're going to offer something less. So instead of offering a $10,000 reduction, you're looking at a $300,000 home. Instead of offering $290,000 or $280,000, why don't you offer closer to the $300,000? It's not going to mean that much. At $10,000 in a purchase price, is going to mean $10 a month in your mortgage payment. But it means a lot to you because you're going to offer a price closer to list, asking the seller to pay the buy down fee. To you, it's worth, in the first year, it's worth $5,500 to you in the first year. So you do want to give the seller some incentive to accept your offer and to pay your buy down fee. I'm not going to negotiate you down. What's the seller strategy in this for those who are listing agents? Well, why don't you put into the MLS? You want your listing to be more attractive than realtor number 2, realtor number 3, realtor number 4. Why don't you put in the MLS that the seller will buy down the buyer's interest rate by 2% in the first year and 1% in the second year? You might just get some people that are interested in knowing more about how the heck do you do that? And again, here's your calculation. If you ever needed to calculate your exact situation, you call Tony. He's got this worksheet. He'll calculate it out for you. So what are you waiting for? Now that you've reviewed how little cash is needed and how do you meet the 3 C's of lending? First C is credit, second C is cash flow, third is collateral. For credit, it's a score that we obtain from 3 of the national repositories, Experian, TransUnion, or Equifax. We as lenders take the middle score of the 3. Remember, if we want down payment assistance, we want to be at least at 640. If you're not there, you work with Tony on credit repair or credit rescore. You can go from anywhere from your score is 0 to 850. You must have at least a 580 for FHA, 640 for down payment assistance, or you can use Tony to get credit repair or credit rescore. So now that you have the credit score, you're above 640, you've done credit rescore, credit repair. Let's look at cash flow, the second C. The second C says add your housing payment to your minimum payments on credit cards, car loans, student loans, any other monthly debts. This is your total monthly debts. This is the numerator for calculating your debt ratio. So if anybody's familiar with math, a fraction is the numerator divided by the denominator. So far, the numerator is your monthly debts. So let's answer, what does your housing payment consist of and how do I calculate my gross income? Because gross income will be the denominator. But let's see, what's in your housing payment? Well, we've seen it before. It's the principal and the interest, the homeowner's insurance, the real estate taxes, private mortgage insurance. Whenever you don't put 20% down, that's accident insurance for the lender. Then if you live in a flood zone area, there's flood insurance. And then if you have a condo or a townhouse, there's typically homeowners or condo association dues. And we've already seen this on a $200,000 loan, that your monthly payment with a rate of 5.625 is $1,842. We're going to see how easy it is to use FCM Express to calculate your payment. So I'm going to bring up my cell phone here, and I just want to show you FCM Express, because realtors, you share this application with your clients. There's no reason why you as realtors are not using FCM Express to get your clients pre-approved right away. The old-fashioned way is, hey, I want you to call my lender, Tony Marino, and you call to Tony, and Tony's on the phone working with another client, so they have to leave a message. And Tony gets done an hour later, he calls back, and the client's out to lunch, or the client's in a meeting. And so another hour goes by. They waste half a day trying to connect with each other. When in essence, with today's technology through FCM Express, you can share this app, Realtor, and give it to them. They at the same time can click apply and they can get started on getting pre-approved. So what do I mean by that? So here is my cell phone. And how do you go about getting to FCM Express? Well, you first have to go to the Play Store. Or if you have an iPhone, you go to the App Store, and then you go to your search box, and you put in FCM Express. And it comes up with this little maroon flag. And instead of say open, it's going to say install. You click install. And then what you're going to do is you're going to go, I was playing around with this, so it's got all my charts already in here. Okay, so here it's going to give us, this is what it looks like when you bring it up. It's going to be Tony Marino, and Tony, correct me if I'm wrong, but you can co-brand this where the realtor's picture and the realtor's contact information comes up. Is that correct?
Yeah, it would be both of our contact info.
So again, realtor, I don't know why you wouldn't want to have your picture, your contact information, and have a piece of technology that allows people to get themselves pre-approved and started immediately. Give them immediate gratification with today's technology. So if you notice, if this had your picture and your contact information, there's only 2 action steps they can take. Share this app. That's what realtors do. Realtors share this app. When you click on it, it's going to say, do you want to share this via email or do you want to share it via text? Most of them do text. They put in their client's text number. It gets sent to the client. You can even call your client and say, hey, do you get my text? You can get started on pre-approval immediately. If they're going to apply, if they say, well, thank you so much, Mr. or Mrs. Realtor, I'm now going, you're going to tell them, click the apply now button, and they'll start filling out screens. And when they're done, it'll go immediately to Tony. But now let's say they want to calculate, they're looking online. They're going out with you on a Saturday, going to look at multiple houses, and they want to calculate what their housing payment's going to be. So what they're going to do is they're going to click the calc button. And what they're going to do is they're going to have to pick, is it a new purchase, a refinance? It's a purchase. So you click purchase. If it's FHA or conventional, let's say it's FHA. And then they're going to put in a purchase price. Let's just say, for sake of discussion, it's $300,000. Down payment, 3.5%. You know, that's going to be the $10,000, $10,500. Term is 30 years. That's good. The interest rate is not 3%. The interest rate is going to be 5.625. Fat fingers, 5.625. Taxes are probably too low at 1.5. So let's just say they're going to be $6,000. Again, you know, having looked online, they will find out what their taxes are, or you, the realtor, will give them some advice as to what the taxes would be. Or if you have them in the back seat of your car and you're driving them around, you might have half a dozen MLS listings. You say, hey, we're going to 123 Main Street. And by the way, the purchase price is $300,000 and the taxes are. They can be doing this in the back seat. You can say, well, why don't you bring up your FCM Express app and let's calculate what the payment's going to be. So the taxes are $6,000. The annual insurance, it says, is $2,000. Let's leave it at that. You know, change it if you like. If it was a townhouse, a condo, you have monthly HOA. And then from there, it's in the state of Illinois. The county is DuPage or whatever county, Cook County, Will County, whatever county you want. And you say calculate. And it comes back, as you notice in the upper corner here, it comes back with the monthly payment is $2,566. It says that the principal and interest is $1,000, you know, down here it's $1,695, but it's also graphically shown in this pie chart. And it shows the taxes, it shows the homeowners insurance, it shows the private mortgage insurance. How great is that? If they then want to see an amortization schedule of what it's going to be payment by payment by payment and what their balance, how far their loan is dropping, amortizing down, they can. So again, it's free to them, it's free to you. What you need to do is contact Tony Marino. His contact information is at the end of this, and get yourself co-branded so you can share this with your clients, that they can get started on calculating mortgage payments as they're looking in the internet or going out with you. And secondly, that they can then click the apply now button and start getting themselves pre-approved right on their mobile phone. So going back to our slide, your gross income is gross income. You get your denominator is gross, not net income, not net of Fed withholding, state withholding. So it's your gross salary, or it's your hourly, your rate times the number of hours that you work. Bonuses, if you're paid bonuses, are averaged over 2 years. Commissions are averaged over 2 years. Overtime is averaged over 2 years. If you're self-employed, you're gonna have to wait 2 years before you can be eligible for a mortgage loan. We have to have 2 years of tax returns. Not, yeah, I'm making $300,000 in revenue and it's written on a napkin. It has to be on a tax return, and we average your net income over the last 2 years. So now that you know the housing and consumer debt and the gross income, how much of a loan can I be approved for? Well, lenders use debt ratios to determine how much you qualify for. The debt ratio is your monthly housing, that PITI, principal, interest, taxes, and insurance, plus all other consumer debt, student, car loans, credit cards, that's your numerator, divided by the total monthly gross income, denominator, and it must be under 45% for down payment assistance, all the way up to 55% if you're using FHA and you're not using down payment assistance. So let's see if we answer these questions. How much down payment do I need? Well, you need 1% of the purchase price, as far as I can see. It's far less than your 1 month's rent and security deposit. How much savings do I need in the bank? Well, if it's FHA, you don't need additional funds in your savings account. How good does my credit need to be? I think we answered it, 580 or 640. 640 if you're using down payment assistance. What is fixed rate versus an adjustable rate? We didn't really touch on it, but we used that 2-1 buy down. We said, hey, would you like, if they think in the future they're going to become home buyers but are pausing, well, that's because they think rates will be lower in 2 to 3 years. So why not get them into a 4% interest rate, a 5% rate, and they can refinance into the lower rate for years 3 through 30. Perfect. That 2-1 buy down has always been there, but when rates were 2 and 3%, no one used it. Now that they're at 6, people should be using it to encourage people to become homeowners. What does my housing payment consist of? I think we broke that down into principal, interest, taxes, and insurance. What are closing costs? We didn't go into great detail, but they're about $5,000 most of the time. What are escrows? Escrows are going to be what you need to set aside for real estate taxes and homeowners insurance. And how much loan do I qualify for? Whatever my income and my I can't go over 45% debt to income ratio. That's the maximum. So your goal, your homework today is to get yourself pre-approved for free. Download that FCM Express from the App Store, from the Play Store, obtain a free credit report from Tony, assemble necessary documents for a full app, get an automated underwriting approval. We run them through Fannie Mae, Freddie Mac, FHA underwriting computers, and they come back and they give us feedback certificates, say you've been approved. Get a pre-approval letter. It's shared with your realtor. Now that you have a yes on your loan request, your realtor is going to go out shopping with you and begin the fun process of finding you that dream home. They're going to review an action plan with your mortgage consultant and with your realtor. The Marino team thanks you. We're committed to financing your dream home and always being available for questions. Tony can be reached at the 847-804-1059 or Team Marino at GoFCM. Tanya Reyes, our senior loan officer at 815-757-6944 or T Reyes at GoFCM. And don't forget to download that FCM Express. The realtor's commitment is to be an effective listener, to find out what your family's needs are. They're committed to finding your dream home and always being available for questions. Once we know that you're doing one of these homebuyer seminars, your realtor's name will go here, your realtor's contact information will go here. You could possibly buy a home for less than your first month's rent and security deposit. Take your first step today. Call me, the realtor, to get you pre-approved with my team, and let's go shopping. Here's some of the documents you're going to need. You can also, realtors, you can also start putting some posts in Facebook with a link to a landing page, letting people know that they can buy a home for as little as 1% down. The landing page looks like this. If you need help with creating this landing page, that's what Tony and I are for. Congratulations, you're on your way toward home ownership. Find out if you qualify for $10,000. Buy a home for as little as 1%. Any questions? Contact Tony Marino, the branch manager, 847-804-1059. Otherwise, email him at tmarino@gofcm.com. So who wants to become a homeowner? Put your name in the chat box. Let's get started.